Alibaba is down 61% over the last 5 years, heading towards its 52-week low. So is this an undervalued company? Will it ever recover from the highs that we saw of around $310 in October 2020? Or is this one we should consider to put away for good? So as always, we'll look at the historical performance. We're going to look at their income statement as well as what we expect for their latest annual report in March 2024. And we'll analyze their bottom line net income. We're going to have a quick update on the health of this company, their total cash versus their total debt. We'll also see how others are performing in their competitors over the last few years. We'll take a quick look at any insider buys or sells over the last few weeks. We'll touch upon the institutions, if there are any updates in quarter four, if they've been adding or selling. And as always, we'll look at some very important financial metrics to understand if this company is going to continue to grow or if the growth has started to slow down. And we'll look at two pieces of information from Morningstar. We'll firstly get their views. They have updated the price targets over the next 12 months. And we'll also look at what the bull and bearish scenario is for Alibaba over the next few years. As always, we'll run them into the valuation model. We have an updated intrinsic value as well as acceptable buy price, and Wall Street have revised their forecast over the next 12 months. So let's jump straight into the company. And as we mentioned, this is one that hasn't had the greatest last 5 years. In fact, over the last year, it is down 20%, and just on a year-to-date performance, down 6%. So it can't catch a break. It isn't the greatest company in terms of historical performance. So let's see whether we can take advantage or this isn't one we should consider. So they do offer a yield relatively new for the company, 1.4% on a trailing 12-month basis, and the current forward PE is sitting around 8.5. Now, in terms of top-line growth, we always want to see 3 to 7%, although for faster-growing companies, we do expect to see double digits. 56 billion reported on their top line in 2019, and we see 5 years later, March 2023, 126 billion. So they have more than doubled their top line over the last 5 years. On a more granular level, a little bit of an inconsistency. We see increases all the way to 2022. In that more recent year, 2023, we do see a drop from 134 billion to 126. Based on the trailing 12 months, which we are expecting to be roughly the essential top line of March 2024, there will be some increase, 131 billion, so we should see a few percentage points to their top line from that year-on-year movement. In terms of their bottom line, well, we can in fact see the decrease, which isn't what we want to see. 13.1 billion in March 2019, 10.6 billion in 2023. So whilst that bottom line has increased to 2021, it dropped subsequently in 2022. It picked up again marginally in 2023. On a more positive note for shareholders and potential shareholders, it is looking like there will be a nice 40% increase to that bottom line in March 2024. So overall, a little bit of inconsistencies on the bottom line. The top line is increasing, but we are hopeful that the March 2024 annual report will be a fairly positive one for Alibaba. In terms of the health check, well, total cash versus total debt, 30.3 billion of cash and short-term investments in 2019, nearly 3 times as growth, 86.6 billion in their latest quarterly report. So they are sitting on a lot of cash. They have been doing some share buybacks, and we will touch upon that shortly as well. When we compare that numerically and directionally to their total debt, what we can see, 20 billion, it has increased to around 28 billion, but we can see their cash position, as noted above, is far superior, and therefore no real issues when we do come to analyze that net debt to EBITDA metric. Now, comparing them to some others in the consumer discretionary borderline retail, we have PDD Holdings, Mercado Libre, we have JD, Coupang, quite a few popular ones and well-known. Over the last year then, Alibaba, not in fact the worst performing, so it might be surprising. JD is the worst performing, down 49%. Alibaba down 18%. When we extend this to the last 5 years, no real surprises. Not the greatest return, negative 60%. But important to note that past performance is an indicator of the future, so it doesn't necessarily mean they will continue to have a poor performance again over the next 5 years. So bear that in mind, but always do your own research and own due diligence. In terms of transaction type, so we have buys and sells, 100 shares over the last month, just to be a bit more relevant and recent. No insider buys or sells noted. When we expand to the last 2 months, again, we don't have anything noted. And over the last 3 months, again, as we can see, there has been minimal movement. Moving on then to the institutional ownership, what we can see around 14.22%. We see around 6 billion worth of sales by these institutions over the last 12 months, with a bit more buying, around 8 billion during the same period. Now, what we can also note in Q1, more buying than selling. Q2, we see the opposite. Q3 and Q4, both seeing more buys by those institutions. So overall, and over the last 12 months, and in fact in the more recent quarter, Q4, institutions have been buying more shares of Alibaba at this very low PE and at this very low price. Now, before we jump into the financial metrics, we can take a very quick look at a relatively new article from Morningstar discussing Alibaba after their earnings. So what we can in fact see is they have cut their fair value estimate. It now sits around $94. They do still give this a 4-star rating with a wide moat, although unquestionably they do give it a very high uncertainty rating. Now, one of the main reasons for this price cut, we can see here, they did reduce it by 27% to that $94 mark. They've essentially reduced their 10-year revenue compounded annual growth rate forward looking to around 4 to 6%, so mid-single digits, with adjusted EBITDA growth to 3 to 4%. Some of the reasons, this is essentially to reflect the intense industry competition, as well as the slower than expected retail sales recovery and the deflationary risks in China. Now, we'll cover some other bearish scenarios shortly after looking at those metrics, but as we can see, Morningstar, and as we're about to find out, other analysts have started to cut their price targets. Now, let's jump into the essential metrics. Free cash flow per share, as always, I do prefer that. The earnings can be subject to essential susceptibility to manipulation by management. So $9.84 in 2014, $63.10 in 2023. It has increased rapidly. We do note that drop. It did then bounce back very sharply. Although we do note in 2024 there isn't expected to be much movement to that free cash flow per share. So do bear that in mind, and we will consider that when using our DCF model to come to the value. Sales growth now, not the greatest. We can see, in fact, their top line has slowed down quite significantly. It used to be strong double-digit increases to their top line, but realistically, even if you were holding this in 2014, you probably would have lost money, even though after, say, 6 to 7 years after, you were seeing some very rapid growth to their top line. More recent years, single-digit increase, 2% in 2023. On a slightly more positive note, 2024, they are expecting around 7% increase to their top line. So we do see it has grown rapidly from around 53 billion in 2014 to 869. Now, they have also done share buybacks. In fact, in the more recent period, as we see from 2021, it has reduced down into that latest quarter of 2.57. So if you were an investor around 2021, they would have returned that excess cash. However, we do know if you were a shareholder in 2014, they were essentially issuing equity from 2014 to 2021. So really the net position would have been a net dilution of your shares over the last 10 years. So it really depends at what point you were a shareholder. ROIC, now what I'm aiming for here is around 10%. What we can see over the last few years, it has straddled just slightly underneath that. Now 9% on a trailing 12-month basis isn't too bad. Ideally, I'd like to move it up more to 10%. That would give me a little bit more confidence. Nonetheless, it isn't the worst at the 7 to 9%. Margins, now this isn't something we want to see, those declining margins over the longer term. Whilst what we want to see is 16% or more in this industry, we do see over the last few years slightly lower, although we can see 2024 is expected to increase to around that 14%. Just a shame given the earlier part of this period, they were having some very, very strong lines on that margin. But again, we can see this is essentially operational inefficiency. Their margins are reducing quite significantly. The same can be said for the free cash flow margin, although even in 2023, that 19% is still looking very healthy, as we want to see a minimum 7% here. But again, just do note both on essentially the sales. When we take a look at the percentage, it has been decreasing over the last 10 years, and this is a common theme that we have noticed on the ROIC as well, and when we look at both margins, operating and free cash flow. Not something you really want in a company you're investing in. You want to see the opposite, but again, just factors to consider. Now, the net debt to EBITDA, earnings before interest, tax, depreciation, and amortization, this shows us the balance sheet strength, essentially saying us over the last 10 years, it wouldn't take Alibaba even one day to pay off all of their debt, net of cash on hand. Now, before we jump into the bullish and bearish scenarios, just to let you know, tomorrow we are releasing our next free weekly article. If you want to gain access to that or of any of these other articles, all completely free, just sign up by clicking on the pinned comment below. So now let's have a very quick look at some bullish and bearish scenarios for Alibaba over the next few years before we get into that valuation piece. Now, in terms of the bullish scenarios, we can see here, not the greatest, but it's saying they should at a bare minimum maintain their gross merchandise volume share in the China's e-commerce space. They also believe that they will increase their key metrics, as we can see, customer retention being one of them, the purchase frequency as well as the average order value. And they also expect that over time Alibaba will deliver better than expected adjusted EBITDA margins despite this competition and reinvestment, which on the flip side we can see that bears will say the exact same, but in fact turn it around. So they do see that there will be a lot of competition in this space. Competitors such as Douyin successfully entering the search-based e-commerce, taking some market share away from Alibaba. And we can see that their expansion into the non-physical goods marketplace businesses will bring in lower than expected margins, which we already discussed are looking fairly low. We would like to see these increase. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first model. We have Graham's valuation. We have the stock ticker symbol, the earnings per share, growth rate long term with the current bond on AAA bonds. We get to an intrinsic value of $94. Market value much lower, so we have our first signal of undervaluation. We then get to the multiples valuation, companies in a similar sector and size. We have their PE multiples. We have the average, multiply that by the earnings per share of Baba to give an intrinsic value slightly higher than the current market value, but again a second sign of undervaluation. Now, whilst the dividend discount model is the third model we're looking at, given the fact they've only recently started to pay a dividend, this one doesn't believe to be appropriate for now. So moving into the DCF model, we have the free cash flow year on year, average 30% increase year on year. We've gone what we believe to be very conservative at a 0% increase over the future, over the 10 years in fact, and beyond. Using our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to that equity value, divide by shares outstanding, and we get that intrinsic value of a significant undervaluation, intrinsic value of $206. Now, what we have today is the valuation coming to the average of these three models, and that gets to $128. Now, remember, we do have a margin of safety that we use, and we start with 10%. We use that if we believe it meets three criteria: a wide moat, strong financial metrics, and good forward-looking data. If we believe that, it's an acceptable buy up to $115. At 15% up to $108, and we keep going till it's near the current trading price, and we can see that is around that 40% mark. So depending on what risks you have in place, your investment thesis, your risk profile as well, that will depend on your margin of safety level, although you may not want to enter just due to the fact that this is a Chinese company and there are a lot of risks and regulations that come with that alone. Now, Wall Street, as we said, did cut their price target quite significantly. This was around $120 to $130. It's now sitting at $105, which is still showing a strong double-digit upside of 45% over the next 12 months. As always, though, do let us know your thoughts in the comments below. Is this one you are still adding? Do you expect it to recover? Given the fact that even the price targets have started to come down is never a great sign. But always keen to hear your thoughts. Don't forget, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.